The good old cash secured put is one of the biggest stock option traps ever known to man. I'm going to prove it to you in this video why, and I'm also going to prove to you why there's another strategy that is similar, but it is 10 times better, 10 times easier to make money. I'm going to show you inside my 7-figure account. I'm going to show you the trades that I'm actually making to prove to you why this other strategy works 10 times better. Okay, so the first thing that we're going to do is we're going to dive into the charts and we're going to break down exactly what a cash secured put is, why they suck, why there's a better strategy, and why the conventional wisdom of people out there just simply get this all wrong. Okay, let's flip it over to NVIDIA stock. This will be a good one to do it on. And the first thing that I am going to do is I'm going to plot the earnings per share growth line on NVIDIA so that we could get a gauge of where profits are going on the company. We have the profit line there. We know where the earnings per share is going. We're going to use this to our advantage. And I guess before we dive into the chart, let's talk about what a cash secured put actually means and what this actually, how you make money with it. Cash secured put is essentially saying, hey, I buy stock, NVIDIA, for example. I think NVIDIA is going to go up in share price. So maybe right now NVIDIA is trading for $182 per share. I'm going to sell a cash secured put for 1 month out and maybe choose a 170 strike price. If NVIDIA falls to 170 or lower, I just simply have to buy shares of NVIDIA for 170 bucks. The benefit of me doing this is I get to generate this cash flow that I could do pretty much every single month. So as long as your stock keeps going up, you're just simply going to keep collecting cash flow month after month after month. It sounds pretty good in theory, and honestly, it could work, but there is a major problem with cash secured puts and why you're leaving a crap ton of money on the table. Trust me, I've been doing this for a decade. I make over 30K a month on average with stock options, not by doing a cash secured put. Stick around. It's all going to click. You're going to be like, oh my God, I was thinking about this completely wrong. Okay. So we have the earnings per share growth line right here. We get it. Earnings per share is going up on NVIDIA quite a bit. We know that by watching other videos on my channel, earnings per share is the number one thing that moves the price of a stock in the long term. Okay, so let's just say that somehow right here, October of 2022, you somehow knew that the bottom of NVIDIA was in. You don't have to know when the bottom of anything is, but we're just going to say that somehow you perfectly knew it was there. Let's say that you started selling cash secured puts. Okay, you're going to sell cash secured puts, and let's just say that you sell 1 month duration puts. Every month you sell another put, another put, another put, and it's going very well for you. All those puts are simply expiring worthless because the share price of NVIDIA is going up. The only way that you could lose money on a cash secured put is if the share price falls below your strike price. So you're good, you're making a lot of money, you feel like a genius. But here's something that you have to think about. Let's say that you sell a cash secured put, for example, right here, with a $20 strike price. If you sell one contract, you are on the hook to buy 100 shares of NVIDIA for $20 per share. That's a strike price that you chose. You think NVIDIA is going to be higher, so you're not expecting to have to buy the shares, but you just think that, hey, it's going to be higher than 20 bucks a share. You're going to be cool. So in order for you to secure this trade with cash, you have to have $2,000 of cash because $20 per share times 100 shares, because every option contract is 100 shares, you have to have $2,000 of cash sitting there doing nothing. But let's think about this. If we're bullish on NVIDIA, if we think the share price is going to go up, while yes, you are going to make money on the cash secured put, what are you doing with the cash that's sitting in your account? You're securing with cash. So while you're bullish NVIDIA doing the option trade, you have cash sitting here doing nothing. Like, think about it. Your cash is sitting there doing nothing. So what if there was a way that you could sell puts, take the cash flow, and instead of sitting in cash, you could just go buy NVIDIA shares? Because if you are ultra confident that your share price of whatever company you're going to do this on, it's going to go up, NVIDIA, United Health, MicroStrategy, Amazon, Triple Q, VOO, whatever, it doesn't matter. If you're confident that the share price is going to go up, you're getting it at a very good valuation level, the company has a moat, they have a durable competitive advantage, and they're just a really good company overall. If you're confident that share price is going to go up, why wouldn't you just want to hold the shares? Why don't you want to buy shares? Why don't you want to buy call options? Why are you literally saying you want to have a huge chunk of your account in cash to generate a little bit of cash flow on the way up? You wouldn't want to do that. That is stupid, in my opinion. So let's talk about a strategy that at initial glance, you might think it's kind of crazy. You might think it's risky. But if you let me explain to you in detail of how this works, and I'm honestly going to keep it high level because we can keep it high level, because it's just really not that complicated to explain to you guys. What if there's a way that you could sell puts secured by your portfolio? So let's just say an example right here. We'll stick with NVIDIA here for a little bit, and I'll show you inside my portfolio of exactly how I do this on real trades in real time. Let's just stick with NVIDIA really quick here. Let's just say that for whatever reason, and I would never recommend to do this, but for whatever reason, you have 100% of your portfolio in NVIDIA stock. Let's say that you have $100,000 worth of NVIDIA stock. If NVIDIA goes up 100%, you double your money. You go from $100,000 to $200,000. But at the same time, you could use that $100,000 of NVIDIA stock as collateral to sell puts when you feel like it makes sense. So not only are you going to capitalize on the share price going up, but as you sell puts along the way up, you're going to make money on top of that money because you're not securing the trade with cash. You're securing it with the bullish company that you're selling puts on. Because if you're selling puts, you should be bullish. And if you're not bullish, you shouldn't sell a put. So if you have a lot of conviction in selling a put, dude, buy the shares, use those shares as collateral to go sell puts. It's very, very simple. Now, we're going to go through a lot of common misconceptions about this strategy of, well, Brandon, what happens if you have to take assignment? What if the share price goes way down? How many contracts can you sell and stuff like that? We're going to cover that in a second. But I just want this to click for you. You are bullish on NVIDIA. You buy the shares. You sell the puts, you take the cash flow, and you could buy more shares with it too. And on top of that, you don't sit on cash doing nothing. So you're capitalizing on the move that you are expecting to come. Very, very simple. Maybe you don't want to buy shares with the cash flow that you get. Maybe you just want to buy calls, and that's okay. It really just depends how much conviction you have in a play that you're going to make. So let's run through another big misconception that most people really screw up right here. And we're going to go to April, where we had the Liberation Day, Trump tariff dump, and everyone, freaked out. Let's go over here when NVIDIA was clearly cheap. It fell to like 95 bucks a share. Okay. What was the herd doing right here? They were panicking. They were freaking out. They were buying put options. They were selling the shares. They just wanted to get out of the market because the world's going to end. So yes, there were probably some smart investors, or they think they're smart, and they're going to say, hey, I'm going to capitalize on this dip. I'm going to sell some cash secured puts right here. And while maybe they did happen to somehow time the bottom in the market perfectly right there, they left a crap ton of money on the table because you sold the put, you collected the cash sat in your account as cash and did nothing. Meanwhile, look at this right here. Meanwhile, NVIDIA bounced over 93% from this level right here. So instead of sitting on $100,000 of cash, if you're going to do it with 100K, for example, why not buy $100,000 worth of NVIDIA stock? That's going to run up to roughly $193,000. You literally almost doubled your money. And on top of that, when it's cheap, you sell puts down here when it's cheap. Up here, when the market ran up a lot and NVIDIA went with it, no, you don't want to sell a bunch of puts up here. You want to sell puts when you feel like the stock is undervalued, when you feel like it's going to rebound back to the earnings per share growth line. Down here, NVIDIA is cheap. Up here, NVIDIA is a little bit expensive because it's above the earnings per share growth line. Just think of this line as like a rubber band. Like if I stretch the stock above it, when I let go, it wants to fling back down. And when I take this line and stretch it down, the stock wants to fling back up to the mean line of earnings per share growth. This is a very proven system that works. Stocks follow what earnings do in the long term, but in the short term, we get gifted with volatility that we could simply just capitalize on. Okay, let's bring this back together a little bit here. And not only do most people screw up by doing a cash secured put, and I know you probably have a lot of questions right now, which I know what you're going to want to ask, and I'm going to get to it. Most people not only mess up by doing cash secured puts, they mess up by doing cash secured puts in a short duration contract. The main problem with that is this. What is this trend clearly doing right here of earnings per share? Up and to the right. This is, 2 years of data right here, though, 2 years of earnings per share growing. But if you just do like a cash secured put for 1 month out and you sell it right here on a perfect bottom, yes, you're going to make money on a cash secured put. But your strike price that you're going to choose, like if the current market is 95, maybe you sell a $90 cash secured put, sure, you made money. But what if there's a way for you to, like, let's just say that you sell that cash secured put for $1,000. What if there's a way for you to sell a 12-month put secured by your NVIDIA shares, and instead of collecting $1,000, maybe you collect, just call it $10,000, almost, 12x more. You collect 10K. But think about it. You now have 10K to work with when the market is cheap, when the shares are beat up, when sentiment is bad, when call options are cheap in price because nobody wants to call options. Like, yes, you have the right idea of selling puts down here when the market is freaking out, when people want to buy puts because the market's freaking out and everyone's, freaking out because it's going down. So people are paying more for puts. They're willing to pay more for that downside protection. So yes, you have the right idea of selling them when the market is down and when it's cheap and when it's compelling, but you're missing the boat. You're missing the boat that you could ride your shares up 93% and you could sell puts along the way up too. So the duration thing, I'm going to sell a 1-year put right here, collect a 10K, buy even more shares while they're cheap, and even maybe buy some call options with that money too. Maybe I'll buy 5K worth of calls and 5K worth of shares. Whatever it is, it is. It depends how highly convicted I am in that trade. Less conviction, I'll buy shares. More conviction, I will buy calls, or a combination of both. And one of the really good ways that you could build confidence, of course, there's a lot of things that we could look at, but one of the simplest ways is if you plot this earnings per share growth line right here, and when the stock is quite a bit below, you know that you're probably going to have reversion to the mean. I know it seems very simple, but trust me, the profits matter for what the stocks do in the long term. And if I pull up this chart right here, my previous video when we were talking about cover calls and why cover calls are horrible, I'll link it here below if you want to check that one out too. But people were asking me, hey, how do you plot this line? And I'm just going to show you one that's already pre-plotted for the S&P. So the darker line here corresponds to the earnings per share growth on a forward basis, and then the lighter line is the S&P 500. So again, at the time of recording this video, the market's a little bit hot. These lines are probably going to overlap again. They overlapped here, they overlapped here. Like, the market follows profits in the long term. This is the actual growth line right here. But what I do when I plot this chart for you guys is I am simply just averaging it, the beginning till the end. And you can see that obviously it's not going to be this perfectly straight line, but it's very, very accurate overall. It doesn't have to follow the exact little dips that the earnings per share does. But for NVIDIA, to be honest with you, it really does look like it's straight up and to the right because their earnings per share growth is relatively explosive. So highly convictive down here to do this stuff. Okay, let's dive into my Charles Schwab account. And I want to show you an exact trade that I am doing currently of exactly how you could capitalize on this. And you're probably wondering, how do I keep my ratios in check? How am I doing this without being on margin? All that stuff, I'm going to answer those questions for you right now. Because guess what? You're not on margin, you're not collecting margin interest, and if your ratios are in check, you are always going to be able to take assignment no matter what. Which, to be completely honest with you, it's honestly meaningless if you have to take assignment because, dude, if you like the stock at, like, let's just go back to the chart, I guess. If you like the stock down here at, I don't know, call it 20 bucks a share, you're going to like it when it's cheaper in the future when earnings per share is higher, meaning if it is below the growth line right here, it's more likely to rebound even faster. So we are totally okay to take assignment if we have to, because we're only doing this on very, very, very high quality companies. We're totally cool to take assignment. I see so many people that freak out like, oh my God, I'm going to have to take assignment on my sold puts. It's like, give me those sold puts. Give me those shares. I will take your shares from you at this cheap price when everybody's freaking out. Because if you do it right, if you do your research, all you got to do is just ride the rebound higher. The shares are eventually going to rebound in price. It might take a week, it might take a month, it might take a year. But this strategy you will do very, very well on. And before I answer your question about the margin and how I do this secured by my portfolio, I want to say one more thing really quick. I have been doing this strategy for roughly 10 years. I've been through bull markets. I've been through bear markets. People ask me in Discord when they join off the rip, hey, Brandon, how would this have worked in 2008? I literally show you step by step, month by month, when in 2008, 50% market crash happened, exactly how we would have survived and capitalized on the dip also. So this works. Okay, so let's look at my account. Triple Q, VOO, little Tesla, little Meta. Don't worry about Tesla. It's kind of irrelevant for this example here. We're going to look at Meta. So here's what I did. I have Meta calls that I bought going all the way out to 2028, $600 strike price. I bought 2 of them, currently have $10,000 on those Meta calls. I have some Meta sold puts, $560 sold put, 5 contracts. I'm up roughly 10K on those. Take a look at this cost basis right here. So notice how it's minus $46,000. That means I collected $46,000 of cash flow when Meta was cheap by selling 5 sold puts. Sold the 5 puts. Guess what I did with the cash flow? I bought 2 call contracts for Meta. I sold them for $46,000 and I bought roughly $30,000 worth of call leap options that go all the way out to 2028 on Meta. I think these options are going to print money, but yes, I think it's going to be bumpy. Now, the excess cash flow, what did I do? I bought some shares at VOO and Triple Q. Now, let's simplify this. Brandon, are you on margin right now? The answer is no. I am on zero margin right now. I am securing the trade with my VOO and Triple Q. Brandon, what happens if you have to take assignment? Okay, all we have to do is say how much money am I on the hook for to take assignment for? $560 strike price. I collected $93 per share in premium. We'll come back to that in a second. But I have to buy 500 shares of Meta for $560 anytime between now and 2028. Okay, so let's head over to Meta. Let's plot our earnings per share growth line. And let's take a look and let's see where the stock is currently at in relation to the earnings. And then this will all come together for you in just a second. So this is the earnings per share growth line right here. The stock is clearly, a little bit below it right now. This dip right here where it fell 21%, that was relatively compelling for me. I think that it was a good buy. And, honestly, I'm not saying I could time bottoms of markets perfectly, but we got it pretty good on Meta, to be honest with you. It was obvious that it was blown out of proportion. It's going to be bumpy going forward, but I think it's going to be up and to the right. So if we sell a 2028 put, the earnings per share growth line is probably going to look like this for the years to come. Earnings per share is going to be way up and to the right. Like, look at my cursor all the way up here. It's going to end up over here. So if you have the ability to buy Meta shares when profits are up here and the stock price is all the way down in this level, that would be a very compelling time to buy Meta stock. Like, why would you not want to buy it for $560 per share? You would want to because it would be very undervalued. On top of that, you get to collect this $93 per share in premium no matter what. So my break even is actually closer to like $470 per share. Like, it becomes very, very compelling. And it's like, this contract is very, very likely to expire worthless. So this is probably just going to be a free $46,000. These calls are probably going to be worth, no one knows for sure, but I'll probably make somewhere around $50,000 to $75,000 on these calls if I had to take a guess. Again, it's a guess. Who knows? I could lose money. Nobody actually knows for sure. But I am very highly convicted that Meta is going to be good in the future. So that being said, I sold the put, took the cash flow, bought some calls, took the cash flow and bought some shares. And if I'm on a hook to buy 500 shares of Meta at a $560 strike price, so if this was 10 contracts, this would be $560,000. So 2 contracts is like $280,000. I'm on a hook to buy $280,000 worth of Meta stock anytime between right now and 2028. But think about that, $280,000. The typical person is going to sit on cash on $280,000 of cash, and they're only going to make a max of $46,000. I am sitting on shares that are probably going to appreciate, so I'm going to make $46K plus the appreciation on the shares, plus these calls right here. And if Meta happens to fall and I have to take assignment, I have this base portfolio of roughly $1 million. There's other shares in here too. There's roughly $1 million of value of base portfolio shares that I could sell to generate cash to take assignment. Think about that. You're basically getting a free HELOC on your house. In what world can you call up your bank and say, yo, I want to do a home equity line of credit on my home. I want to pay nothing in interest. And yeah, that's what I want to do. You can't do that anywhere else. But here, I am selling puts when the companies are cheap with a strong moat, strong, durable, competitive advantage, and I'm okay to hold them for the long term. I sell longer duration puts, roughly call it 1 year on average. It's much safer. It's much easier. These companies have more times to boost earnings per share. When they boost earnings per share, the stock is likely to follow that in the long term. So I've been doing this for roughly 10 years and I've been assigned, I could count on one hand how many times I've actually been assigned by doing this because I'm very, very particular when I research this stuff. Like I research thousands of companies every week and I'm very, very choosy when I do this stuff. If I get assigned, great. I'll take assignment of the shares at a cheap valuation level and I'll simply ride them back up. Maybe I will sell cover calls on them to get rid of them on the way up, but this system simply works. Paying nothing in margin interest, it's very low risk. I have a plan if I were to get assigned. If the market crashes like 40 or 50%, I'm going to be just fine. I have all my ratios in check, so it's no problem. Okay, so if you got value from this video, you have to watch the video below. It covers cover calls a little bit. It goes more into this strategy right here, more of the details and when to do trades and stuff like that, more the sentiment, more of how to maximize premiums when you do it because you could really capitalize on humans. Watch this video below. It's going to help you out a lot. Trust me. See you guys there. Have a good one.